The core contradiction is historical and numerical. In 1950, manufacturing accounted for 27% of U.S. GDP and employed nearly 33% of the non-farm workforce. Today, those figures hover near 11% and 8%, respectively. This catastrophic deindustrialization mirrors the United Kingdom's experience a century prior, where manufacturing's share of GDP fell from a peak of approximately 40% in the mid-19th century to below 20% by 1930. Both nations simultaneously transitioned from being the world's foremost industrial producers to relying on financial services and consumption to maintain economic metrics. The process was not a natural evolution, but a deliberate, short-sighted institutional choice to prioritize financial yield over industrial capacity. The resulting trade deficits and structural unemployment were then papered over with cheap debt financed by foreign capital. This is the financial historian, where money, power, and history collide, and nothing is ever as simple as it looks. Financial engineering cannot replace physical production forever. To understand this, we need to start earlier. The British trajectory provides the essential historical template for structural decline. Britain became the world's first industrial superpower, peaking in the mid-19th century with its factories producing over 50% of the world's pig iron and 80% of its coal output. The financial mechanics of this supremacy were simple. Exports of manufactured goods, textiles, machinery, coal, created massive trade surpluses, and these surpluses were then reinvested globally through the City of London. The pound sterling became the world's reserve currency because it was backed by the physical, tangible output of British industry. The mistake began in the 1870s and 1880s, when Britain began to prioritize its role as the global financial hegemon over its status as the global industrial producer. As competition intensified from newly unified Germany and the rapidly expanding United States, both of whom adopted newer, more efficient industrial technologies, British investors increasingly chose to export capital rather than reinvest it in domestic factories. By 1913, Britain's foreign assets were valued at approximately $4 billion, generating foreign income far exceeding the value of its domestic manufacturing exports. This was the real shift. The City of London, with its profitable international lending, insurance, and shipping services, became the engine of the economy, masking the gradual decay of the domestic industrial base. The trade surplus in goods steadily eroded and eventually turned into a structural deficit, which was papered over by the enormous non-trade income generated by overseas financial investments. The economy operated on a financial illusion. It consumed more than it produced, funding the difference with the yield from past capital accumulation. The numbers told a different story. The productivity of British workers lagged behind German, and American counterparts, and capital investment in advanced manufacturing techniques became stubbornly low. The inevitable crisis arrived with World War I. To finance the war, Britain liquidated a significant portion of its overseas investments, weakening the financial income stream that masked the trade deficit. Post-war, the fatal decision was made in 1925 to return the pound to the gold standard at its pre-war parity of $4.86. This overvalued the pound by up to 10% against the dollar, making British exports prohibitively expensive and cheapening imports. This policy was a deliberate concession to the City of London's financial interests, maintaining the prestige of the pound for international finance, at the direct expense of the struggling manufacturing sector. Confidence became currency. The industrial sector, already weakened by decades of underinvestment, was delivered a fatal blow by monetary policy. Coal strikes and industrial unrest followed, driven by the inability of industry to compete or pay decent wages. The result was the irreversible decline of the industrial heartland, Lancashire, the Midlands, the industrial North. Unemployment soared in these regions, creating the first structural unemployment pattern of a deindustrialized nation. By the 1930s, Britain was structurally dependent on the continued stability of its financial services and its residual colonial network. The financial sector did not cause the technological obsolescence of the factories, but the institutional priority given to finance accelerated the abandonment of industry. The nation became a rentier state, living off past wealth while its productive core hollowed out. The financial center prospered. The industrial periphery decayed. The core structural revelation is that financial sophistication, when decoupled from physical production, inevitably leads to national economic fragility. The system was optimized for financial yield, and industrial capacity became a liability. The transition to the modern American mechanic reveals a more rapid, more aggressive version of the British template, driven by institutional finance and policy choices over the last 5 decades. The American industrial base peaked in the immediate post-war period, fueled by the dollar's supremacy and unmatched technological capability. The decline was accelerated by 2 primary structural shifts: the prioritization of shareholder value and the integration of global supply chains dictated by financial optimization. The shift began in the 1970s and 1980s with the rise of the financialized corporation. Under pressure from activist investors and an evolving legal framework, corporate management increasingly prioritized maximizing short-term quarterly earnings and share price performance, often measured by metrics like return on equity, ROE. This led to a cold, clinical calculus. Domestic manufacturing, with its high labor costs, capital expenditures, and environmental compliance, became a drag on short-term financial returns. It was replaced by financial engineering. The institutional incentive became clear: move production offshore to low-wage jurisdictions, a process greatly facilitated by China's entry into the WTO in 2001 and the collapse of shipping costs. This offshoring was not an optimization for national output, but for corporate profit margins. U.S. capital became a global arbitrage machine, chasing the lowest cost of labor and regulation. The numbers are decisive. Between 2000 and 2010, the U.S. lost over 5.8 million manufacturing jobs, an acceleration of the pattern that began decades earlier. The structural consequence of this move was the creation of a massive perpetual trade deficit, financed by the very nations to whom production was outsourced. China, for instance, accumulated hundreds of billions of dollars from exporting goods to the U.S. and, following the petrodollar model, reinvested this surplus into U.S. Treasury securities. The U.S. economy, like interwar Britain, now consumes more than it produces, funding the difference with cheap debt. This is the rollover risk inherent in the contemporary U.S. economy. The stability of the financial sector relies on the continued willingness of foreign creditors to fund the industrial deficit. The final institutional layer is the financial sector's dominance. The sheer profitability and political influence of Wall Street meant that policy, regulation, and talent were constantly drawn toward financial services, derivatives, and complex trading, not industrial research and development. This created a profound power asymmetry. The average compensation in the finance sector far outpaced that in engineering or manufacturing, ensuring that the best human capital flowed to the highest yield sector, the non-productive financial layer. The illusion holds until it doesn't. The reliance on cheap, imported goods and foreign debt meant that the U.S. deliberately sacrificed supply chain resilience and technological autonomy for marginal short-term corporate profit. The COVID-19 pandemic revealed this fragility brutally. Critical shortages of basic medical supplies, semiconductors, and industrial components exposed the strategic risk of having ceded essential production capacity. The financial gain was immediate. The strategic loss is cumulative. A clear modern case study is the collapse of General Motors and Chrysler in 2008, followed by the U.S. government bailout. The bailout saved the financial institution, but did not fundamentally reverse the institutional mindset. Manufacturing capacity continues to be a secondary concern to financial structuring and market capitalization. Markets enforce what politics avoids. What cannot be repaid will be rolled over, but the cost is national strategic capability. Confidence decides who survives. The final escalation reveals the consequences of this institutional choice, which are now structural and geopolitical. The decision to prioritize financial yield over industrial capacity is not merely an economic oversight. It is a fatal erosion of national power and resilience. The pattern of decline, from the British industrial center to the American Rust Belt, culminates in the inability to independently generate the resources necessary for sovereign action and domestic stability. The mechanics of the modern consequence are centered on inflation risk and geopolitical asymmetry. The enormous U.S. fiscal and trade deficits are financed by the ability to issue debt in a reserve currency. As detailed in the historical analysis, the UK's structural decline was exacerbated by the loss of its financial subsidy. The U.S. is now facing a similar pressure as foreign nations actively diversify away from the dollar. If foreign demand for U.S. treasuries diminishes, the U.S. Treasury must offer higher yields, or the Federal Reserve must effectively monetize the debt. Both outcomes are inflationary. The core inflation is not merely a monetary phenomenon. It is the price of funding a consumption-based society that has abandoned its productive capacity. This is the inevitable fiscal repricing of the free lunch. The decline in manufacturing output has also crippled the U.S. capacity for rapid military mobilization and technological independence. The military-industrial base, once the engine of U.S. innovation, is now heavily reliant on brittle global supply chains for critical components, from rare earth minerals processed in China to specialized microchips produced in Taiwan. This creates an existential security vulnerability. When the UK lost its industrial dominance, its military power, though masked by the empire, eventually waned because it lacked the sovereign industrial capacity to quickly adapt to new threats. The US is repeating this mistake. The ability to produce is the ultimate form of strategic reserve. The social and political consequences are equally severe, mirroring the structural unemployment and regional decay of interwar Britain. The The decline of the American industrial core, the Rust Belt, created entire regions of structurally unemployed labor, leading to political polarization, social degradation, and a rejection of the financialized coastal elite. The financial sector created the wealth, but the industrial sector provided the jobs, the social cohesion, and the middle-class stability. By allowing the latter to atrophy for the benefit of the former, the institutional system created a crisis of legitimacy. The Greek debt crisis serves as a sharp modern comparison. Greece was forced to shed its domestic industrial capacity and rely entirely on financial services, tourism, and external debt. When the crisis hit, it had no domestic production base to fall back on. The entire nation became a financially dependent periphery. While the U.S. is the financial core, the erosion of its industrial base makes it increasingly reliant on a small set of technologically autonomous, highly productive nations, Germany, Japan, South Korea, and low-cost producers, China. This reliance transfers wealth, transfers technology, and transfers risk. The decision to treat manufacturing as a high-cost liability rather than a strategic asset is the deadly institutional mistake repeated. The nation is optimized for quarterly earnings, not long-term resilience. Financial engineering provides a powerful illusion of stability, but it is ultimately decoupled from the physical assets that create real wealth and confer real power. The system is consuming its own seed capital. Physical production is the only true collateral. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.